Daily bias is determined through logic and narrative, not just random patterns. This is exactly what I'm going to teach you in this video, so watch until the end. I assure you that this will be the only video that you need to clearly determine your daily bias. What is daily bias? Daily bias refers to the anticipated direction or the potential direction in which the current daily candle or the candle that we're dealing with could potentially close or is expected to close. Basically, daily bias is a prediction of the direction in which the daily candle could close. Obviously, it is not just a random guess. There is a systematic prediction based on certain key factors and concepts that I will discuss in this video. If you do want to follow trades that I make daily, go and follow my Twitter and also join my Telegram. I also do want to give a quick shout out to Sham for the video idea and also Romeo for shedding light on turtle soup and candle range theory. Okay, so why is daily bias so important? And what is its actual significance? To answer this question, we have 3 key points to discuss, which are outlined in the chart and will be elaborated on to give you a clear understanding of their relevance to trading. The first point is edge or technical edge. Technical edge is the high probability of one scenario happening over another. It's the edge that leads our system to profitability. Without an edge, the system wouldn't be profitable. When you follow the same logic and framework repeatedly, and that framework has a technical edge, it means that over a certain period or amount of data, some scenarios will occur more favorably and frequently than others. This consistency is what defines edge or technical edge. The second point is draw on liquidity. Draw on liquidity involves understanding the market narrative and identifying potential key levels that the market might reach and why and how it could reach those levels. By knowing this, we can use the draw on liquidity to our advantage and position ourselves accordingly. This positioning is determined through your daily bias, which helps us anticipate where the market is likely to move. Lastly, the main significance of daily bias is to facilitate lower time frame entries. By identifying and understanding our daily bias, we gain insight into the potential direction of the current daily candle. This knowledge allows us to position ourselves in the expected direction, leading to increased profitability. Therefore, daily bias gives us a technical edge, helps accurately determine our draw on liquidity, and facilitates effective lower time frame entries. Here is a list of concepts we will use to find and determine our daily bias. I will go over each of these concepts in detail and do my best to explain them thoroughly. This way, you can use these concepts to find your daily bias for the day, the intersession, or whatever your trading needs may be. We're going to start off with structure, which is the foundation of every single technical chart or analysis. Structure is used in almost every concept or theory that exists, whether it's Wyckoff, classical supply or demand, or support and resistance. Structure is the basis of all of these concepts. We are not going to use typical or conventional structure because it's subjective and lacks logic. Instead, we will use structure in conjunction with turtle soup or liquidity pouches. We all know the market never moves straight up or down. It always has pullbacks or retracements, and even within these pullbacks, there are micro retracements. This is essentially how the market moves. There are 3 types of market profiles. The first is the bullish market profile, where the price makes higher highs and higher lows, moving in an uptrend. This is called a bullish structure. The second is a bearish structure, where price makes lower lows and lower highs. The third is a ranging structure, where the price doesn't have any clear expansion and is stuck in a range with consecutive highs and lows. This is called a ranging structure. To measure or gauge the market structure, you can ask yourself a few questions and try to find the answers on the chart by looking at the swing highs and swing lows. There are only 3 scenarios. Price can either be breaking above the highs and rejecting the lows, which we call a bullish market. When I say rejecting the lows, I mean the price is never able to break below the lows. It can go below them, but it cannot break them. However, it can break above the highs, which defines a bullish structure. In a bearish structure, the price clearly breaks lows and rejects highs, indicating that the price is in a bearish structure and the draw on liquidity is lower. The price cannot expand above the highs and only expands below the lows by breaking them. This is what we call a bearish structure. In a ranging structure, the price is stuck between highs and lows and does not have clear expansion or significant swing points. This is why we call it a ranging structure. Structure is not absolute, it is relative. It proves an idea of the market profile or the direction the market is going and the liquidity it's trying to reach. You don't necessarily have to open longs in a bullish structure or shorts in a bearish one. You can even open counter trades. The purpose of structure is to give you a scale for the amount of risk you should take per trade. If the structure is bullish, meaning it's rejecting the lows and breaking above the highs, you should risk more on long trades or buys. The same applies inversely for a bearish structure. Now, another concept that we will be using is the PD array matrix. I assume that most of you have an idea about what the PD array matrix is and some of the most important PD arrays. As we all know, for the price to react off a certain key level, there needs to be a PD array, such as an order block, breaker block, or an FVG. PD arrays basically act as a catalyst to drive the price from a key level towards draw on liquidity. The PD array matrix is essentially a dealing range of an expansion swing divided into 2 halves. When we divide each expansion swing into 2 halves, we end up with the upper part and the lower part. The upper part is known as the premium, the midpoint is known as the equilibrium, and the lower part is the discount of the dealing range. That's what we call a PD array matrix. After dividing each expansion swing into 2 halves, we find PD arrays inside that dealing range, both premium PD arrays and discount PD arrays. This gives us a complete and full PD array matrix of that expansion swing. Next, we will combine structure with the PD array matrix and explore the combinations these concepts together can provide. This will help us in finding our daily bias. We will look and see whether the price is in premium, discount, or equilibrium, and based on those factors, we will decide our daily bias and combine it with structure. Now let's consider some scenarios that price can have during a bullish structure or bullish market. The first scenario is when the structure is bullish and the price is in premium. What tends to happen is that the price retraces or pulls back to the discount or equilibrium before moving higher. More often than not, when the price is in the premium and the structure is bullish, you don't always look for buys or longs in the premium area. You wait for the price to retrace back into the equilibrium or discount, look for an order block or PD array there, and then look for longs in the discount region rather than the premium one. Another scenario is when the price is in discount and the structure is bullish. In this case, the price will try to find a PD array, such as an order block, breaker, or FVG, that will act as a catalyst for the price to move higher. When the price is in the discount, you don't need to wait for the price to retrace to anything. You can look for longs there and match it with the PDRAs. Another scenario is when the price is at the equilibrium. The price follows the same logic as when it's in the discount. When the price is at the equilibrium, you can match it with any PDRA, find a catalyst like an order block, breaker or FEG, and then it will expand higher from there. This logic gives you parameters and criteria about the areas and prices where you can look for buys or longs. When the structure is bullish, you won't always look for buys. There will be times when you need to wait for the price to retrace or pull back to the premium, discount, or equilibrium before it moves higher. You can use the same logic for bearish structure. If the price is in the discount and the structure is bearish, you can wait for the price to retrace back to the premium or equilibrium before it moves lower. Similarly, if the price is already in the premium, you can match it with a PDRA and look for shorts. The same applies to equilibrium when the price is in the equilibrium. Here we have a typical bullish daily candle divided into 4 dynamic phases: open, high, low and close, or open, low, high and close. Price never moves straight up or straight down. It always moves in phases and different profiles. According to CRT, each candle is a range in itself with its own open, high, low and close, like a typical range. With this in mind, we should always look for particular times of the day to position ourselves towards the draw on liquidity. We don't buy at just any time of the day, even if we expect a bullish day. Instead, we wait for certain times of the day once a low or high has been formed, and then we look for buys or longs accordingly. For example, if the structure is bullish and the price is currently in the equilibrium, we can wait for the price to open. The open acts as a phase of accumulation, which can be in the form of a CBD or an Asian range. Then we wait for the London Open to form the low of the week during a discount or equilibrium PDRA. This PDRA could be in the form of an order block or a breaker block. We look for longs or buys at the discount region instead of buying above the discount or during the opening time. Similarly, the daily range is capped once the high or the low of the day forms, either at the premium or the discount respectively. This is how a single candle is divided into 4 phases, as it never moves straight up or straight down. This concept can also be applied to a 4-hour or even a 1-hour candle. The 4 phases of a candle are open, high, low and close. Each phase has its own characteristics and dynamics. The open of a candle represents a phase of accumulation where orders or interest are generated. Then, either the high or low of the day is formed, depending on the market profile in the PDRA matrix. Once found at a particular time of day, the price distributes from there and expands either higher or lower respectively. It then forms the opposing end of the range, resets, and the reset is in the form of the candle closing. We then wait for another day. Here is an example of a bearish candle. First, the price opens and presents a phase of accumulation. Then, at a specific time of day, it makes its high and distributes lower to form the opposing end of the range, which is the low. It then closes above, and these are the 4 phases and dynamics behind a candle. Now this is the main part of the video where we discuss something really important. We will integrate the structure concept, the PDRA matrix, and the open, high, low, close concept. By combining them in a logical manner within a conceptualized framework, we will introduce another concept, the last candle profile, using the if and then logic. This part of the video is crucial because it explains how to use the logical framework to determine your daily bias. By doing this, you will often be accurate with your daily bias, which will facilitate your lower time frame entries and help you identify draw-on liquidity and even more. Now, let me explain the last candle profile to you. The last candle profile involves determining whether the previous candle was a ranging or expansion candle. There are only two scenarios for the last daily candle profile. If the last daily candle was a ranging candle, we can conclude, using the if and then logic, that today's candle has a high probability of being an expansion candle. This isn't guaranteed 100% of the time. We might have another ranging candle. However, more often than not, if the last daily candle is ranging, we're likely to see an expansion candle. This is because a ranging candle represents an accumulation of orders or interest in the market, which usually leads to an expansion. The larger the accumulation phase, the bigger the expansion is likely to be. If the last two of the three candles are ranging, we can expect a more significant expansion, either upwards or downwards. Using the if and then logic, if the last daily candle is an expansion, today's possible scenario includes a range, a retracement, a reversal, or another expansion. These outcomes are based on previous factors and concepts explained earlier and are determined logically using the if and then approach. You will need to consider the timing as well. For example, if on Thursday we reach a high time frame key level objective and that objective is met, then on Friday you can expect a range or a reversal. By combining the if and then logic with the last daily candle profile, we can conclude the daily bias for the day. Here we have a case study for the last daily candle profile. The last daily candle is a ranging candle, indicating it doesn't have a clear expansion move. Based on this factor, we'll combine it with our other concepts and use the if and then logic. According to if and then logic, the structure is bullish, and on the PDRA matrix, we are at the equilibrium with an FEG, which is our PDRA. Given these factors, the only high probability outcome is an expansion higher. We used proper logic within a structured framework, not just a random pattern. By applying the if and then logic based on the if and then factors, we conclude that a high probability outcome is an expansion higher. Here's another case study. Using the if logic, we can see that the structure is bearish. Observing the chart, we are in the premium region on the PDRA matrix, and there is an order block. The next step is to determine if the last daily candle is a range or expansion, which we can see clearly is a range. Given these if factors, we conclude that the only high probability outcome is an expansion lower. Again, using if then logic, we reached a high probability prediction. Let's take a look at one more insightful case study. The structure is bullish on the if side, but on the PDRA matrix, we are in the premium region and the PDRA is the high, indicating we've taken a high. Even though our structure is bullish, the last daily candle profile shows an expansion. Based on these factors, we conclude that the only high probability outcome is a retracement lower or a reversal, which is exactly what happened. What I'm currently teaching you is about edge or technical edge in trading. We know that no single edge or trading model has a 100% hit rate. There's not a single system with a 100% win rate, and trading losses are normal and inevitable. You can't avoid losses, they're a part of the trading process. Do not give up, learn from your mistakes. The best approach is to accept and learn from them. If you seek perfection, you won't improve. By accepting losses as part of the game, you'll see a huge improvement in your trading and how you view the markets. In the market, nothing is absolute. Everything is relative. You should accept these concepts with a pragmatic and practical approach, always thinking in terms of probabilities. No matter the edge, losses are inevitable and you must accept them. What I'm teaching you will give you an edge in the market, which is essentially the high probability of one outcome over another. I've provided you with a logical framework, and as a trader, you should go into the charts, backtest, and reverse engineer this framework as much as possible. Watching videos alone won't make you proficient. The way to study the market is through reverse engineering, backtesting, and forward testing. Use the framework, apply the logic, and determine your daily bias by reverse engineering the concepts I've explained. Another concept to integrate into your process is weekly profiles. There's no strict rule behind them, and you can learn them in the core content. ICT derived these profiles from a combination of PDRA matrix and structure, leading to weekly profiles. Using weekly profiles is optional, but can help boost your confidence in your daily bias and process. Your main objective is to reverse engineer and dissect these concepts in the live markets to see how well they work. Important notes include avoiding reliance on trading patterns, as they often lead to losses. Successful trading is based on narrative and logic, not random patterns. Your system and trade entry model should be based on sound logic and a structured framework, not on arbitrary patterns. You can also use CRT logic to it, and it's going to enhance your process even more. If you don't understand CRT, I've done 2 videos on it before. This is a series of 10 videos, and I will teach you everything for free. Okay, we're going to do some backtesting. First, in our top-down approach, we need to find the structure and see what sort of structure we're currently in. We'll start with the weekly chart, which I usually begin with. For simplicity in this video, we're going to be skipping the monthly or the 3-month chart. We will start with the weekly, as it is effective and keeps things straightforward. So to determine the structure, we need to see if the price is breaking highs or lows. It's clear that the structure is bullish. This conclusion comes from the price rejecting the lows and breaking above the highs, indicating a bullish structure. With the structure identified as bullish, the next step is finding the PDRA matrix. To do this, we need to look for an expansion swing. In our chart, we see that the price broke above a high and rejected a low, marking our expansion swing. Now, we examine the PDRA matrix within this swing to understand our current position. Inside this expansion, we find an order block. The price has tested this order block, and the last daily candle is ranging. Given these factors, the structure is bullish, we are in a discount phase, there is an order block, and the last candle is ranging. This suggests that the only probable outcome is an expansion higher, and this will likely be our draw on liquidity. Today is also the Monday candle, so it could be a ranging day, but as I said, I anticipate an upward expansion, so we'll see what happens. You can also select this as your CRT range because it's at an important level, marking the open of the order block. This was the filter for the CRT, and it showed a failure swing. After a failure swing, an expansion is highly likely, so we expect an expansion higher based on these factors. So let's see what happens. Okay, so you could have easily exploited this whole daily candle on the lower time frame, but we will discuss that in a later video. But you can see that you got it exported, driving towards this high, and now we will look at the factors again and see where we are. So, the structure does remain bullish, so let's examine where we are on the PDRA matrix. We see that the price broke above this high, and the low that broke above this high is the low. So we'll take a Fibonacci measurement from here and calculate it. You can see that we are currently in the premium of the PD array matrix. The last daily candle shows expansion. So based on these factors, the next daily candle is likely to be a ranging candle or a retracement lower. We may retrace lower, reacting towards this block, finding support here, and potentially moving higher again. Let's see what happens. So we came back down lower to this block again, and then looking at the PD array matrix, we are now in a discount. The structure is bullish, and the last daily candle is an expansion, so we can expect a reversal from here, or maybe a ranging candle. Okay, so we've got a ranging candle, our structure is bullish, and within the PD array matrix, we are in the discount. We see an expansion now, and we are in the context of the sequence. So let's see if the price goes higher again. We expect expansion from here. We have a down candle, and we have met our first target. You can see we also tested this rejection block, and based on the PD array matrix, we are in a discount, have tested a rejection block, and taking out a low. These factors suggest a likely expansion higher. This Thursday's candle indicates a target from here, so let's see what price does. We formed this order block. Let's see if the price reacts from here, potentially moving higher. We are now looking at the factors again. The structure is bullish, and within the PD array matrix, we're in the equilibrium. The last daily candle is a ranging candle, so based on these factors, and through a logical framework, we can expect an expansion higher, which has happened. Our objectives have been met again. After each high and low is taken out, we will follow the same logic repeatedly, examining the factors and concluding the outcome. The structure is bullish. In the PD array matrix, we are in the premium, and we have taken out the high. We expect high bullish prices, but anticipate a retracement to this order block before moving higher. Again, the structure is bullish. We are in the premium, and the daily candle is an expansion. Based on this, we expect a ranging candle or a retracement lower and then higher. We have taken out this high, so our first target is this low, and then here, where we find support and may go higher again. The price came above this high again, tested this order block, and remained bullish. In the PD array matrix, we are currently in the discount. The price tested this order block, and the last daily candle in the profile is an expansion. So we do expect a reversal from here. We have taken out this low, and our draw on liquidity is here. Calculating our PD array from here, we are in the discount, having taken out a low. The last daily candle profile was an expansion, followed by a range, and now we expect an extension higher. Today's Monday, we can expect this low to be taken and then higher. We took down this low and then higher. We are expanding higher now, having taken out that high. This is the plan that we will follow. So now, you should try it on your charts yourself and tag me on Twitter with your efforts. You can ask any questions on here or on Twitter, and I'll make sure to answer them. As I've said, I will be uploading a candle range theory video every Sunday and an indicator video every Wednesday. Thanks for watching. Till next time, happy trading.